Good evening, ladies and gentlemen. Welcome to our September training session. My name is Leigh Maingard. I'm a director at Intersect. Thank you for joining us. We're heading quickly to the end of the year. Just a procedure for this evening. Everybody's on mute. So if you have any questions that you'd like to ask, you're more than welcome to put it in the chat box. And then when we get to the end of the session, we will go through those questions. If you want to put your camera on, that's also fine, but on the mic you will be you are muted. So thank you for joining us. This evening we've already done a training session during the year about the 10-year maintenance plan, but I thought it would be good to add the administrative budget to the discussion and just have a look and see where and what the differences are between the administrative budget and the 10-year maintenance plan, or the MRRP, the maintenance reserve and replacement plan. So this evening we're talking about your finances, the finances of your scheme, and yeah, your planning, financial planning for a scheme's future, and obviously financial planning. The administrative budget and the 10-year maintenance budget is absolutely crucial to make sure that your scheme is financially ready for the day-to-day and the long-term expenses that it must incur or plan to incur. So we're going to have a look at that tonight. So as we always start off with a legal framework, the STSMA, or the Sectional Title Schemes Management Act, sections 3.1a and 3.1b in particular. 3.1a talks about the trustees must maintain an administrative fund for operating expenses. And as we go through the slides, we will go into more detail. So if you're not familiar with them, and I'm sure you all are, but if you're not, we will drill down into that a little bit. Section 3.1b talks about the trustees must maintain a reserve fund for future capital maintenance. So immediately we can see the difference in the admin fund being for operating expenses, late in the afternoon, and then the reserve fund for future capital maintenance. We can really see the difference there. In prescribed management rules 21 and 22, both budgets must be prepared annually. And I think this is extremely important with the 10-year maintenance plan, where schemes seem to sometimes overlook this and think that they've got a 10-year plan and they don't have to roll it over. And you'll see in the slides to come that one of the main things about the 10-year plan is that it's a rolling 10-year plan. So every single year that plan needs to be reviewed, needs to be updated and approved. And then prescribed management rule 24 sets minimum contributions to the reserve fund. So this is a calculation that needs to get done before you actually get to the details of the 10-year plan, to determine what the minimum contribution will be to the reserve fund. And that's also quite important to consider, especially what we see is that trustees look at the 10-year plan and they don't necessarily look at, the reverse of that. They look at the 10-year plan, but they then think that there is a minimum amount that they need to contribute, and they don't have to actually look at the 10-year plan as a whole. And then the enforcement of these two budgets is that the community scheme ultimately can intervene if a scheme fails to prepare or follow the plan. And that's obviously done. I mean, the community scheme is not going to come to you, knock on your door and ask you if you've done the plan and have a look at it. But certainly from an owner perspective, an owner can go to CSOS and ask for relief to impose on the scheme to ensure that the two budgets are prepared and presented to the owners. So the purpose of the administrative budget covers day-to-day running costs for 12 months. We talk about operating expenses. We'll look at the details of that in this slide. You'll see that there are some examples there. You've got to ensure that the scheme has enough money for recurring operating expenses. So important in that sentence is the word recurring. You have monthly expenses, quarterly expenses, biannual and then also annual expenses. So the body corporate must, in that budget, make provision for the different types of operating expenses for that scheme. It's there to ensure that the scheme operates efficiently and meets obligations. So obviously, the body corporate will have an obligation to pay the cleaning company, the lift company, its monthly insurance, etc., etc. To provide financial accountability and transparency. And the transparency, I think, is extremely important here, and I don't really think that it is lacking in general. But it's important that when the budget is presented to the owners at the AGM, that they are able to at least understand, and if they ask questions, when they're given answers, that they can understand why the body corporate is budgeting for certain expenses. And it's important to also understand that the owners only really have one opportunity, and that is at the annual general meeting to really participate in how the budget has been put together and what the expenses are allocated for. So it's very, very important that it is transparent. Examples of admin budget expenses: security, insurance, cleaning, municipal services, staff salaries, management and audit fees are just a few to mention. The main one there that's not mentioned is obviously maintenance. And the difference obviously between the maintenance reserve plan versus the admin budget is the capital expenditure and the size of the expenditure that's anticipated there. And again, CSOS, as mentioned on the previous slide, CSOS requires that the budget is transparent and that it is presented to the owners. And accordingly, in your annual general meeting, there is a agenda item where the administrative budget needs to be presented and then be approved by the owners. So the budget is prepared by the trustees in principle, presented to the owners, and the owners must then vote on that budget. What is the purpose of the maintenance plan, or the MRRP, or the reserve fund? Either of those three words are sufficient to explain this budget. So the sectional title scheme, any building is worth millions of rands. It only makes sense that the buildings and equipment and services that are provided to the scheme over time will deteriorate. I think that's extremely important to understand the infrastructure of the building. Doors, automatic doors, garage doors, access control systems, cameras, pumps, sump pumps, those kind of things. Over time, those things, although you might still maintain them on a regular basis, there will be a time where it comes to the end of its life and it needs to be replaced. And with long-term planning, obviously a scheme without it, the scheme will incur potential emergency costs where they haven't planned for it, and which ultimately also leads to special levies. And those levies would then be unpredictable because it hasn't been planned for. Nobody's looked forwards and looked at the infrastructure and the assets of the scheme to determine how much money needs to be put away, so that if that happens one day, or if it's planned, that there is sufficient funds for that. So the plan covers long-term capital repairs and replacements over a 10-year cycle. It ensures that the scheme has sufficient money for major non-routine expenses. For instance, replacing a lift, but it's maybe debatable if it's routine to replace a lift every 20 years or maybe every 30 years. But at least if you know that the lift has to be replaced, then over time you can save the money to make sure that you've got the money when the lift has to be replaced. It also provides predictability and transparency in levy. So again, the plan must be clearly outlined: which years, what expense is going to be incurred, what that anticipated expense is, taking into consideration escalations and inflation, and that must then convert to a levy that each owner will contribute to monthly over a period of 10 years. Key similarities between the two budgets: they're both mandatory under the Sectional Title Schemes Management Act. They must be prepared annually and approved at the AGM. So again, the trustees are responsible to prepare those budgets, but they must be approved by the owners at the AGM. They are funded by the owners' levies, calculated on a participation quota. So just going a little bit sidetracked here, participation quota is only calculated on the section or the unit or the livable area. You do get sections that storerooms can be sections, parking bays can be sections. But in that case, you might find that the rate per square meter that's applied to those kinds of sections are different to the habitable section. But they're still based on the participation quota. It ensures the financial stability and compliance of the scheme. It's there to identify and plan and budget for major capital repairs and replacements. It's there to ensure the scheme has adequate funds available when needed, and it is there to provide financial accountability and transparency. And I think the accountability, transparency, to be prepared to plan ahead is ultimately the underlying importance of both these two budgets. So what are the key principles of the administrative budget? Accuracy, because this is a 12-month budget over 1 year, it's very important that the trustees, when they prepare the budget with the assistance of the managing agent, that they are as realistic as possible and also as accurate as possible. And it's important for them to take in consideration inflation rates and escalations. Escalations would obviously be more related to contractual obligations, while inflation might be related to other things like, for instance, labor. If you've got a cleaning company or the body corporate is employing staff themselves, they might consider what the inflation rate is and how to determine what the increase would be in their provision for paying those staff members. Transparency, all items must be disclosed and explained to owners. And this is where it's important for trustees that when they prepare their budget, that they have a good understanding of how they've arrived at the cost that they've put into the budget for the next year. And that when they are asked at the AGM, that they're able to then explain to the owners how they've arrived at the cost, or why there might be a new cost, or why an old cost might have been removed from the budget. Fairness, the apportioned levies must align with participation quotas. And this is quite an interesting point, although we're not going to discuss that tonight, but it is a very interesting topic, especially on the participation quota side, where sometimes a body corporate, somewhere down the line, for whatever reason, it could be a human error. It could be that the sectional title plans maybe have not been updated. But ultimately, the budget, because it is based on participation quota, and that will give rise to the levy that each owner must pay, must be apportioned and aligned with the correct participation quota of the scheme. Compliance, it must comply with the Sectional Title Schemes Management Act and also the prescribed management rules. And in sustainability, ultimately, the budget must ensure the scheme can operate without a cash flow crisis. And when we talk about a cash flow crisis, what we find very often, especially with new developments, is that the budgets prepared by the developer before the scheme comes into being is they try and keep it pretty low, so that obviously when they're trying to sell the apartments, that the levies don't look so high. But at the end of the day, what we have found in the past is that within at least 6 to 12 months, you can see that the levies that are being collected are totally insufficient to cover costs, like, for instance, especially your utilities, council expenses. So it's very important that the budget is a sustainable budget for that 12-month period and then going forward. Key principles of the maintenance repair plan is asset preservation. So that extends the life of common property assets. And this is ultimately one of the most important parts of this plan is is because you're planning ahead, you are going to preserve your assets. Those assets being infrastructure, as we mentioned before, lifts, gates, electric motors, and things like that. Financial fairness, it avoids sudden unfair levy increases, like for instance, special levies. Legal compliance protects trustees from any liability claims. And the same would apply to the admin budget as well. But certainly from a 10-year maintenance plan perspective, the trustees' liability there could be bigger because of the types of assets or equipment that needs to be maintained, or structure as such of the building. Value protection, naturally speaking, that if you maintain a property on a regular basis, it's going to look good. People will have a good feel for the building. And especially when you want to try and sell your property, you should be able to get a really good return on your investment. And on the opposite side, if the building is falling apart and it's derelict, people won't want to buy there and you won't get a good return on your property. So I think it's extremely important on this point as well that when owners go to an AGM, that they don't just merely accept the 10-year maintenance plan, but they understand what the budget entails and what items, assets are going to be improved over the next 10 years. And then from an operational perspective, operational certainty, and it enables trustees to act proactively. And I think this is also, again, a very important thing to remember is the proactive nature of the 10-year maintenance plan. Maintenance in general is mostly retroactive. Although, obviously efforts always made to try and be proactive. But I think this is a very important part of this plan is the proactively being aware and planning for future maintenance. Key differences, just really a comparative the admin budget is a 12-month horizon, so you're only looking for 12 months down the line, while your 10-year maintenance plan, your reserve fund, is a 10-year rolling plan. And it's important to remember that it's a rolling plan. So every single year that plan needs to be redone. The admin budget covers day-to-day recurring expenses, while the reserve fund covers capital repairs and replacement. The admin budget is for predictable regular costs, although there also can be sometimes maintenance items that have not been planned or have not been foreseen, which can arise. So it's not totally irrelevant to the admin budget. But generally speaking, a body corporate will make provision for any unforeseen expenses under maintenance. And the 10-year plan or the maintenance plan is for irregular large costs. So it's irregular to obviously replace a lift every couple of years. That's why you plan for it every 20 years or 30 years, etc. And interesting enough is that there's also different ways of how schemes budget for those kind of items. Some might consider that they need to replace a lift in 15 years' time, and that because it doesn't fall into the 10-year plan, it's not included until the 10-year plan rolls over and it reaches year 15, which then effectively becomes year 10, and they then start planning for that. While other schemes, sometimes they start putting money away now already, even though the lift might only be replaced in 15 years' time. And which is not a bad thing to do, considering inflation. As an example, a lot of lifts are imported from China or from Europe. And obviously with the exchange rate to the rand, nobody knows where that's going to go. So it's very difficult to really plan that. And hence, again, doing that exercise on an annual basis is very prudent. The admin budget is based on prior year expenses plus inflation or escalations, escalations being contractual. And then your 10-year plan is based on a life cycle forecast and future cost estimates, as well as inflation. That's obviously inflation is not irrelevant to the 10-year plan just because it's a forecast over 10 years or 9 years, etc. And then from a compliance perspective, prescribed management rule 21 is very important for the admin budget, while prescribed management rules 22 and 24 are relevant for the 10-year maintenance plan. What I mentioned earlier, there's a list of expenses that can fall under the admin budget. But I think it's also very important, to understand that each body corporate has different expenses or different makeups, and that each body corporate will have unique or might have unique expenses that it needs to budget for. So this is certainly not an exhaustive example of administrative budget expenses. But these expenses covers all recurring operational costs, including municipal charges, insurance premiums, which includes liability and fidelity insurance, cleaning and garden services, security being guards, access control, CCTV, repairs and maintenance, routine, but not of a capital nature, where the maintenance plan is of a capital nature. Routine, but also, as I mentioned in the previous slide, repairs and maintenance. Although obviously you're budgeting for routine repairs and maintenance items, there certainly will be expenses or opportunities where the body corporate may need to spend money on something that they have not planned for. Management and accounting fees, audit fees as well, bank charges, stationery, communication, and then obviously staff salaries. That is if the body corporate employs staff themselves. Examples of reserve fund or maintenance plan expenses on a structural basis: roofing, painting, waterproofing, external walls, boundary walls. Mechanical and electrical will be pumps, lifts, generators, access gates, solar, if it has any solar. Services being plumbing services, drainage, stormwater systems, refuse areas. Also will be included there is electrical as well, although mechanical and electrical could also be an item under which the electricity will fall. Amenities such as pools, gyms, clubhouses, security systems, hard surfaces, roads, paving, boundary walls, again, fencing. Roads and paving will obviously be where a scheme has a lot of common property, and especially in the bigger schemes, where there are driveways and roads to be maintained on the common property. And then compliance upgrades, fire systems, fire control panels, smoke detection systems, accessibility and energy efficiency retrofits. So you can see that you can break down the maintenance plan into specific subjects or lines, if you want to call it, and be very more specific. And you can see that some of these costs are not really costs that could just fall into a normal 12-month admin budget. And as mentioned before, there could obviously be a lot more examples that hasn't been mentioned yet. So it just depends on the scheme, how the scheme is laid out, the design of the scheme, and what the additions are. When we look at levy contributions, pretty simple, I think. If you look at the admin budget, the total annual admin budget, what we normally do is we divide it by 12 to get a monthly figure, and then each person's participation quota as a percentage is then calculated to give the owner's contribution in terms of their levy. And it covers the monthly recurring expenses, as we mentioned before. And the reserve fund budget, bit more complicated. Your total 10-year capital cost forecast divided by 10 years, as I mentioned above, at the admin budget divided by 12 months. And then it's adjusted for inflation and existing at the existing balance, but adjusted with inflation and any escalations that whoever's prepared the budget believes should be applied. And generally speaking, what we found in the industry is that on a 10-year maintenance plan, the average escalation, although each line item in your 10-year maintenance plan might have different escalations applied to it, but the average we find, especially from the consultants directly, is that the average escalation is generally 8% per year. But again, if that budget is reviewed every year, then you could find yourself that could go up or down. But I think it's very important to also understand and consider that when a budget is done for the next year, the importance of considering if a levy should be reduced, even though, not even though, but if the same amount of money is not required as what was required in the previous year. And we've seen that where bodies corporate have reduced levies. And the problem is that if you reduce levies, at some point those levies have to go up, and that's when all the problems start, where people have to suddenly pay 50, 100% more in levies because the requirements for the funds that the body corporate has to hold on to be able to pay for future expenses is suddenly increased. So the calculation must meet Prescribed Management Rule 24, where the minimum contribution formula is applied. I mentioned that earlier, and then we've said this before, covers long-term works of maintenance. So the implementation process for the administration budget. So the first thing to do is to review your prior year's expenditure, just to get a feel and to see where you have incurred expenses. It's always a good time to also then look at those expenses that you have incurred, which you didn't budget for, and to consider if they should be in the next financial year's budget as well. So you then adjust those expenses based on increases or the inflation, or both for that matter. Insurance, a little bit more complicated, especially where you have a valuation done every 3 years. We see a lot that when the valuation is done, we generally find that the bodies corporate are overinsured because the insurance premiums escalate at a higher rate than what the building costs escalate. It's an interesting topic, but that's why the expenses have to be reviewed and have to be applied specifically to that expense. Utilities, we all know that utility expenses are going up quite excessively every year on the 1st of July when it comes from the city of Cape Town. So that needs to be applied, and those escalations, as we know, on electricity is not your normal 8 or 10%. As you know, previous years we've seen even 17, almost 18%. So it's very, very important that those utility expenses, water, sewage, refuse, sanitation, electricity, is looked at individually, and sufficient escalation is allowed for those expenses. And then add new or anticipated expenses. As I mentioned, you might have incurred expenses on maintenance in the previous year that you didn't plan for, but you now believe that you are going to incur that cost going forward. So it's important to consider that and then to put that into your budget. So the plan is then drafted, the budget, sorry, is drafted by the trustees, and then it's presented to the owners at the annual general meeting. And the owners ultimately approve the budget. And the importance here is that the trustees obviously present that budget and explain to the owners why whatever increase they've applied or have not, why that's come about, and they provide them with the details. And then the budget is adopted, and that will then give rise to the levies that are charged to each individual owner. The implementation of the MRRP is a little bit different, although the outcome is the same. So the first thing to always do is to do a condition survey of the building, and that will include the inspection of the buildings, all the equipment, the assets of the building, and the common property, because obviously you've got to make provision for expenditure on common property as well, as we mentioned in the previous slide, where we have items like, for instance, paving or roads, if it's a big scheme, boundary walls, etc. Then life cycle forecasting has to be done, and this is where whoever is doing the 10-year plan, hopefully it's a consultant, where they can then assess what the lifespan of the equipment is, or the assets. Excuse me, and then accordingly they will then apply their calculations to arrive at a potential expense in the future. Let's say, for instance, it is the roof as an example, and you've got 8 years to go before you really have to replace the roof. Then that would be their role is to determine the life cycle, and estimate when that life cycle comes to an end and when it needs to be replaced. Then they need to obviously apply a cost estimation. So they use the current replacement values, and this is where they adjust it then for inflation, or at an escalation as mentioned, which normally is around 8%. So the 10-year projection will then schedule when all the work needs to be done, the replacement, all the repairs work needs to get done. That plan is presented to the trustees, and then ultimately to the owners at the AGM. And at the AGM, the owners are ultimately also responsible for approving that plan. And again, once that plan is approved, the levy contribution to this fund is then determined. And just to confirm, although it's not in the slides, each body corporate must have a separate bank account for their 10-year plan levies, and those levies must be transferred to that bank account on a monthly basis. And only at the time when the expense must be incurred from the 10-year plan budget, per the 10-year plan, can money be withdrawn via resolution from the trustees. This is just a very simple levy calculation example. If your annual budget is 1.2 million rand, and your PQ value as an owner is 5%. If you take 1.2 million divided by 12, you get to 100,000 rand a month. 5% of that is 5,000 rand. So your contribution on a monthly basis to this budget specifically would be 5,000 rand, and 5,000 rand times 12 will then give you your contribution at 60,000 rand per year. 5% is quite a big PQ, so don't be too worried about the 5,000 rand. It's just an example. But that's the most simplest way of explaining how the levy calculation is done for the admin budget. On the 10-year plan, again, a little bit more different. Here we look at the items. In this example, it's painting specifically. But ultimately, what you'll look at is your 10-year maintenance plan is what needs to be done and at what time. And then you look at that cost estimate. And in this case, we've taken the painting of the building at today's cost, let's say, for instance, would be 1.2 million rand for a specific building. And we've applied a 6% annual escalation on that. And that could be because the cost of paint or the cost of labor maybe has not gone up so much, and it's anticipated to remain at that figure. So it could be 8% as well, but in this instance it's 6%. And then by year 8, the cost would be approximately 1.8 million rand. So if the body corporate is not planning to put away X amount of money per year to have sufficient money, and that's in this case 1.8 million rand, the only way that the body corporates will be able to make sure that they can paint the building when it needs to be painted is to raise a special levy. Now, obviously, over an 8-year period, the body corporate can suddenly start contributing towards the maintenance plan. So this is obviously a worst case scenario where no money is contributed to this expense. So, and I would be very happy to assume that a body corporate is putting money away, irrespective of what the amount is, and because it is annually reviewed, the body corporate can obviously increase that contribution to make sure that they have sufficient money, even if it is only in 8 years' time. But as an example, if the body corporate was putting 225,000 rand away on an annual basis for the painting, then there wouldn't be the need for a special levy. And again, your 10-year plan is also calculated on the PQ value of each section. So the importance of both budgets, I think this is very much a summary, but I think it's important to just repeat it. So the admin budget keeps the scheme running day to day, as we know, where your reserve fund is for long-term expenses. On the admin budget, ensures schemes runs smoothly and efficiently. It's predictable levy contributions for owners, so the owner knows exactly what they can budget for every month, because the levies will only increase, if necessary, every 12 months. It builds trust in the trustees' governance of the scheme and the management of the scheme, and it supports financial stability and scheme reputation. While on the reserve fund side, the MRRP provides financial stability and asset protection. Financial stability means that the body corporate has funds in a bank account. It's accruing interest on a daily basis. And when it comes to the time when the asset has to be repaired or replaced, then the funds are available. So it gives financial stability and asset protection. It's a predictable levy. So again, like the admin budget, once that budget is approved, owners know exactly what they need to contribute every month. And it also gives the trustees and the owners the foresight of what they need to contribute going forward to cover the 10-year maintenance that they're planning for. Asset value protection, we've mentioned that it gives rise to higher resale values, peace of mind. There's no sudden levies, special levies that need to be raised to attend to any maintenance that needs to be done. And the fairness of the levy, that it's spread over time and all owners contribute fairly towards that expense. So it's not suddenly like a special levy. The whole issue with special levies is that it's suddenly imposed on owners. It's a bit of a shock. They normally don't have a lot of time to pay off their special levies. And obviously by planning ahead for your 10-year maintenance plan, you stopped up the possibility of a special levies, and you allow for owners to contribute over a period of time. What are the risks of ignoring it? If you've got a weak budget, firstly, you're going to have arrears. Arrears with service providers. You can have service cutoffs like electricity and water. You can have unpaid contractors, which means that your contractors will stop doing work in your complex, which means deterioration of a complex and it's under common property. And then obviously day-to-day dysfunction. We certainly don't manage schemes like that, but we're certainly aware of schemes where owners are not paying their levies, budgets are not being prepared, and even with budgets that are being prepared, owners are not paying their levies, and it just absolutely runs into the ground, and the scheme is almost unmanageable. So shortfalls, schemes will run at a loss, although bodies corporate are not there to make profits, but certainly if they don't have money, the money can only come from one place, and that's the owners. And if the owners are not going to pay, then it's pretty much dire straits. Arrears, inability to pay service providers, they won't be providing a service to you, which means that again your assets and your common property will deteriorate. You might have owners that do actually want the scheme to work and that are paying the levies, that complain to CSOS, and suddenly you have a CSOS matter against the trustees or the body corporate, and then things can become very interesting very quickly. And I think the most important thing is for those of you that are present that are trustees, the trustees may be held personally liable for negligence. And I think that is a very important thing to consider when you are acting as a trustee or if you want to put your hand up and become a trustee. On the reserve fund side, legal liability, trustees can be held personally responsible for negligence, as mentioned, the same as the admin budget. CSOS matters, CSOS orders against the body corporates to enforce them to create a 10-year plan or get one drawn up, and then to raise levies. Special levies, ultimately, like I said, if the money is not in the bank and the owners are not contributing to the fund, then the only way to raise money is through a special levy. Reduced values, lower resale values, ultimately you're losing out on your assets, your fixed asset, especially if you bought it as an investment and you might have a tenant in there. And then on the financing risk, from an owner perspective, is that banks might be very hesitant to approve loans in poorly maintained schemes, which means that if you want to sell out of the scheme, you might actually not be able to do that because the bank's not prepared to provide financing for the purchaser. And then the second last slide is summary and a call to action. So both budgets are legally required and equally important. The adjoint budget, again, short-term operational orientated, while your 10-year plan is long-term and capital maintenance orientated. Owners' levies fund both these budgets. It ensures smooth operations and future sustainability. Important to remember is that both these budgets are calculated very differently, which is very important to consider when they are done. From a trustee's perspective, they ensure that both budgets are accurate. They must make sure it's transparent and compliant with legislation. And then important is for the trustees to continuously monitor their budgets versus their actual expenditure, because this will also be an indication or give the trustees indication of where they're potentially overspending and where they're underspending, or where they didn't budget for and where they are actually spending money. So that's a very important aspect and responsibility from the trustees side. And then also for the trustees to commit to proactively managing and attending to maintenance for the scheme. Although the 10-year maintenance plan is a very proactive plan, it is for capital expenditure, as we mentioned earlier, for big ticket items, painting of the building, replacing of roofs, those kind of items, while being proactive on just normal day-to-day maintenance is also very, very important to consider. And then from an owner perspective, the owners approve the levies or the budgets that will then give rise to the levies that they must pay. And what it does, it secures long-term and operational value for the scheme and as an owner in terms of their assets that they own in the scheme. And just the last thing, scheme manage finances proactively. If the scheme is doing it proactively, there's a saying that says plan today and protect tomorrow. A very important thing to consider. Right, so that brings us to the end of the slides. Just so that you are aware, we will share that with everybody in the next day or two. I'm not sure if there's any questions in the chat. Let's have a look and see. Okay, Paul, good evening, Paul. You well? You touched on this. I'm just going to read it regarding long-term replacement items like roofing, sewer pipes, plumbing. It is likely that these will be the largest expenses that any scheme will face. I believe that trustees would be failing in their fiduciary duty should they not provide for savings for replacement of these items or the remaining expected life of the item, even if replacement is only expected beyond the 10-year framework. Paul, yeah, so I made that comment where there are schemes that even though the replacement of a specific item, as I mentioned, like a lift, could only be in 15 years' time, that they already start saving for that. So there's certainly absolutely nothing wrong with doing that. I think maybe with regards to your comment, certainly where the replacement costs are substantial. I mean, like lifts were 2, 3, 4 years ago were maybe 600,000 to 800,000 rand to replace. Now schemes are looking at R1 million, 1.1, even to 1.2 million rand to replace that. So I totally agree with your comment. Very valid indeed. I see Pat is typing profusely there. We'll wait for that. Hi, Pat. For trustees, is there any protection, for example, insurance against being responsible? So there is, Pat, yeah. So in the scheme insurance policy, there's public liability, and obviously there's also trustees liability insurance. So obviously those two kinds of insurance are a little bit different from each other, where your public liability insurance would be where the scheme is being negligent, where common property has not been maintained, which is, I mean, it does make sense that it would fall under that public liability. But in the case of public liability insurance or claims, the body corporate or the trustees would need to be shown as having been negligent in not, you know, acting out their duties and responsibilities. While trustees' liability could be something else where trustees have made certain decisions that have been negative or negatively affects the scheme. So, where an owner feels that a decision made by trustees and implemented, for instance, was not in favor of the body corporate, you might potentially claim against the trustees' liability in the insurance policy. So there is some kind of cover, but ultimately the Act does make provision that a trustee in his personal capacity might be sued for doing something incorrectly or wrong as well, which negatively affected the scheme. So there is cover. It just depends on what kind of claim is put against the body corporate first and then the insurers. You're welcome. Yeah, so what I was just going to mention is, well, we've got a little bit of time. If anybody else has any more questions, welcome to ask. Is that generally speaking, we do find that there are schemes where trustees are very, very actively involved in the maintenance of the scheme. And quite rightly, they do take on the role of preparing the 10-year plan. Legislation actually says that the trustees must have prepared the 10-year maintenance plan. So what that also implies is that they can actually outsource the preparation of that 10-year plan, and there are companies that specialize in that. So generally speaking, more often than not, the trustees will employ a infrastructure consulting business, people that are engineers that know how buildings are built, that are close to what the cost would be of replacing certain things, to provide them with that professional assistance. And I think that's very important for schemes to consider that, especially when you're dealing with a big scheme. And that doesn't mean that a small scheme shouldn't do that either. I mean, the fees and the consulting fees are always relevant to the size of the scheme. So I think, if there is a scheme that hasn't used professionals, it's always a good exercise to at least get the quotes and consider what you'll get from that consultant. Yeah, Pat, I totally agree with you. I think, in bigger buildings, the danger is that, especially if it's a big building and it's a busy building, like, we are involved in certain schemes where it's mixed use, where you've got retail, you've got office tenants, and you've got residential. You've got different facets to the building where you have, different kinds of access control. You've got different kinds of pumps. You've got pumps for pumping away sewer, and you've got pumps for some pumps to make sure that any groundwater doesn't rise and goes into the lift. You've got access control. You've got the fire equipment, fire sprinkler systems. It becomes very, very technical, and you can break down that infrastructure and that all those assets in the scheme, and you can see that when you look again, you suddenly need 5, 6, 7, 8 different kind of specialists or consultants or engineers to actually be able to provide you with just the normal maintenance. And obviously thinking about 10 years from now, it will be even more complicated for trustees to even attempt those big kind of buildings. So there are those companies around, and they certainly do provide a really good service in terms of what they do. All right. I don't see we've got any more questions, so I don't necessarily think that there's any further need. But if there is anything that anybody maybe wants to ask afterwards, you're more than welcome to email me. I'm happy to chat to you on the phone or send you an email. We will send out the recording and the slides, so that you will receive that in the next couple of days. Livio has a quick question for us. see what that is. Okay, in preparing the budget, is it legal obligation to adopt a three-quote process to find the best cost for whatever needs to be done, whether day to day or 10-year, or is it just good governance? Livia, yeah, so I think firstly it is very good governance. I think what is important though is, for which budget are you looking to get quotation? So obviously from a 10-year maintenance plan, the whole principle of the 10-year maintenance plan is that you're replacing something that's irregular. So you're going to spend a lot more money on a 10-year maintenance plan item. So it's good governance, and I think in terms of having to report back to owners, especially when you're preparing a budget as well, and you get to the year when you actually do need to replace that item, as an example, a lift. I think it's good governance and transparent to provide the trustees with, so not the trustees, the owners with the information and able to provide them with the quotations that they obtained. On a normal admin budget, I think the important thing there to consider is that a lot of trustees have, let's call it a policy in place, where certain expenses up to a certain amount, just one quote is required. And then over a certain amount, we call it like in bands. So they work in brackets, if you want to call it like that, over a certain amount. And then under the next amount, maybe two quotes are required. And let's say if it's over 10,000 Rand, three quotes are required. And then you also have the situation where you've got building managers or estate managers who will then, obviously it's probably easier for them to obtain quotations because contractors will generally come to them at the building, and it's easier for them to also deal with contractors. So the point I'm really trying to make is I think you must just always remember the practical implication of getting quotations because, contractors on the other side, are not always when they find out that you need to get three quotes and that the cost is potentially going to be 2,000 Rand, then they won't pitch up or they're not interested. So I think the trustees, each board of trustees must just apply a rule. And based on that, if things are within that, and also if it's transparent and they're able to inform owners this is how they are going to operate, I think then it's fair enough not to get three quotes. But I think the monetary amount, the value of those brackets must just be determined very carefully. I hope that helps. Okay, Pat, I see another couple of questions. You've got some time. Okay, Pat, you're welcome. Thanks for joining us again. Always good to see you. All right, guys. So if that's the end of the evening, thank you so much for your time. I hope it's been informative. And we'll send through the recording and the slides in the next couple of days. And hope to see you at our next session. And if there's anything in between, like I said, please feel free to email me directly. Thanks so much. Have a good evening.